Our next guest does say the Trump White House shifting policy mix is changing his economic outlook for the U.S., downshifting GDP growth estimates. He says the balance of risks now tilted to the downside. Joining us this morning, S&P Global Ratings Chief Economist Satyam Panday. Satyam, thanks for being with us. Talk about this inflection point and what's feeding this change in view.
Well, it's the policy mix. The narrative is completely dominated by trade tariffs, immigration curbs, and the federal government workforce. We now think that the quarterly sequential growth rates will be downshifting to more closer to 1.6% quarterly average. So if you think about the quarter four over quarter four growth rate for the U.S., it should be closer to 1.6% rather than the 2.5 that we saw last year. So that's a pretty big slowdown for the economic growth.
Unemployment, you see, yesterday I think we had Wells say we might top out at 4.8. You're not quite there, but you're pretty close, right?
Yeah, we're pretty close because once the growth slows down, we do think that the unemployment rate will start to drift up. Most likely we'll get to about 4.6% by the middle of next year. And then it'll probably start to move back down again because we have the Fed cutting its rates as well for next year, about 100 basis points. And then there's also the fact that the labor force participation rate is going to be moving down as we are an aging society here.
What do you think about the impact to sell bonds as a result of these auto tariffs, that they might be inflationary? Because, that was the original thinking about tariffs going into the year, that it was all inflationary, and then we saw the other way and we're worried about growth. Which one should the bond market be more worried about at this point? Or is it both stagflation and that's a bigger problem?
Well, at least in the near term, it is going to be adding to some of the costs to the auto prices. I think the personal consumption expenditure basket has about 4.4 or 4.5% share that gets spent on autos, and not just the new autos, but the used cars, as well as the insurance for new cars and the repairs, right? So when you start to add those up together, the knock-on effect on the CPI inflation is probably about 30 basis points. So you can imagine if you have a forecast of a 3% inflation by the end of this year, you'll probably want to add about 30 basis points to that. Now, the Fed's looking at that, and they are also thinking about the erosion of the purchasing power in the consumer sector. When you start to weigh those two together, at least in the near term, they are probably going to just pause, see how much the demand side starts to weaken before they really go out with cutting rates.
You do have one cut penciled in, I think, for 25. I wonder what you made of Muslim's comments yesterday that these tariff hikes could bring what he called persistent inflation. Do you consider that view to be widely held on the committee?
I think for now, we are of the view that the committee as well is of the view, I think, that this is a one-time price level bump. We will most likely see the disinflationary pressures again start to build in the beginning of next year, and then we'll move towards that 2% target as the year goes by next year. But yes, we don't think of this as a ongoing inflationary pressure.
Well, you cover Canada and U.S. Next time, maybe we'll talk some Canada, given they have an interest in all of this as well.